million of cash in that period, but your minimum cash balance required is also 200 million, obviously, because you need that much cash on the balance sheet. Therefore, guess what? You have a $24 million shortfall. And the formula here is just that if that number is less than zero, you borrow that against you take down the revolver like that. If it's greater than zero, you pay down. You don't just pay down the revolver. If there's a balance in the revolver, you pay it down. If not, you use it to the next tranche of debt, right? So that's why you use a minimum function. Does that make sense for people? Yes? Okay, a lot of nodding heads, awesome. Then you have, what's the cash available after revolver pay down? Same exact thing. What is the minimum balance that you have outstanding of term loan A? If you have excess cash, pay it down. If not, keep moving, right? So, and then you have cash available after term loan A, same thing for term loan B, right? Does this make sense? I mean, structurally, it's a pretty kind of, it's not uber complicated, right? So, everyone tracks this so far? Okay, yes, any questions? No. All right, and then, yeah?
Do you go to whatever has the highest interest rate, or do you, like on the loan, or do you just go, right, maybe?
Yeah, I mean, either, I think, look, there's certain covenants, and I mean, we can get into a whole discussion around it. Some people say, hey, you got to pay us down first before you start paying other people. You know, some people say, hey, you know, it's just, typically in this case, we go with the more senior loan because of that reason, right? So in practice, how did you guys do covenants for senior versus junior?
Senior versus junior, we would have a step back.
Yeah. Right, but would you want them to pay the senior first before they went down to that? Yeah, so that's usually right, because they're like, well, how come this guy or gal is getting their money and I'm not getting my money first, right? So I think it's sort of a seniority question. There's often nuances. Like, I think if one is super expensive, then like, but you clearly have taken on that debt already, right? So it's sort of like you want that leverage, but yes, you could try to restructure, recap it. But typically there's covenants in there that might prevent you from going too far deep under the stack. It's a good question. Sorry, then what we have is actual balances for this, right? So all you need to build is, what is the opening balance? What is the drawdown or pay down? What is the ending balance? And what is the interest expense, right? So again, in this model, we're not doing a, you know, like a drawn fee or an undrawn fee yet, but it's sort of like, we're just assuming you're borrowing on average, and these are averages. So you take the beginning balance and ending balance, average of the interest rate, and get your interest expense. Same exact thing you're doing for all of the pieces of the balance sheet. And then now you have sort of ending debt balance on your balance sheet. You've got ending debt balance, you've got goodwill, and then you've got cash balance as well. And now it kind of comes together. And the final piece is this interest, right? So you're just adding up each of the sub rows of interest in that period and then plugging it into the interest line. And now it completely flows through and you get the actual like real net income for that period. Whereas in past, it wasn't including that, right? Any questions on this? Yeah.
Is there a preference to the closing versus average balance on interest payments?
Say that again.
Is there a preference to the closing balance versus average balance?
So there isn't. I mean, if you're doing a quick and dirty model and just want to do ending balance, totally fine. I mean, the conceptual theoretical point is that you'd have to do like a quarterly cash flow or something to know when exactly it's being paid. In a PE deal, we ask our people to build quarterly models just because, you know, what period is, you know, interest rates. They usually do at every sort of quarter points. There's a big difference if you pay the interest off, if you pay the loan off Q1 versus Q4, right? But in these case studies, I know it doesn't matter one way or the other. I just do averages because it's almost a little more exact to do something that's inexact, right? So you're saying, okay, let's assume it's middle of the year versus one or the other, right? Okay, good question. Anything else? Oh, okay, yes, ma'am.
Is there a reason you don't include a circ switch in your interest expense? Or
so this is already like a option for time circularity. Okay. So you can actually, it just runs through it already. Yeah. What's the question over there?
I guess, is there a reason why you're plugging your balance sheet through equity instead of rolling in from net income?
You could do that. It comes to the same thing. Good questions. Anything else? Okay, cool. So last thing, you're like, oh, I've done all this now. Like, can we just get to returns already? So now you're like, okay, cool. I've got returns. You get to sort of same thing as before, right? You need to get to proceeds to sponsor, which you take the exit multiple, take out, you know, the debt component, and you get to sort of sponsor proceeds. And okay, now who is asking me for formulas? I'm putting you on the spot. So you put $1 billion in, you get out $3 billion, 3.2 That's roughly 3 times your money. So your 5-year period, what is the returns? 25%. So yeah, so kind of, again, you have an Excel, you can't build this on paper. I think, roughly get to that point. And yeah, look, I think this is sort of what's expected in a case if you go through, if you go through a 3-day case, right? Again, this is also what's expected if you're doing a round 1 model, probably not as much detail as we go into this. But something like this, maybe slightly less detailed than this, is expected in a round 1 model, like on the job, right? So again, part of this training is to help you guys in recruiting, but it's also to help you succeed, in these jobs when you get there. And so take the same pieces that we're telling you on the case study side and apply it to the day-to-day on the summer internship or the job or whatever. So any questions on this so far? Or no, it's not so far, but that's any questions on the model? Okay, cool. Last thing I'll show you on the modeling front is the final model here. Again, this is probably an even more advanced model, and we've built this. So all of these models were created by like VPs and associates. So these are actual like stuff that we're working on, or not deals, but the analysis. This model has a few more things in it. So it's got like management role, it's got sort of option pools, basically, things that are not going to be asked in case studies at all. So you don't have to do any of that. But to the extent that you want to learn even more, or you want to sort of do even more sort of stuff, you can certainly do that. Option pools, right? They're kind of like, there's a time-based component, there's a performance-based component saying if you get to a certain threshold of, and we have things here, right? Like commitment fees and so on. Here we've gotten a little bit more of a detailed. We're also doing interest expense on cash, or cost of interest of cash, and and things like that. In this case, we are doing sort of this time-based and performance-based component. Just quickly, what that means is your management sort of has an incentive to performing the deal, and so if they get a certain kind of pool, if they stay through sort of for 5 years, you get a certain portion of that, and then if they perform, so if you get 2 times your MOIC or 3 times your multiple money, you get even more, and they get upside in that, right? So that's what that is. Again, if you are confused about how to build that, just refer to this. It does a really good job of going through that. There's a scenario here about recaps, I think, where if you need to recap your money in like a certain point in time, we've built through that as well. If you're going to exit in year 3 or year 4, or take money out, right, or something like that, you can build that in here as well. So again, I'm just showing that to you as sort of a like a something you guys can go and work on after the fact. So let me pause here for a second. We skipped over our second. Let's just power through for another like 10, 15 minutes, and then we can end at that point, because I think, unless we guys wanted to break, the thing that's left is the first. Is there anything? So we've covered a lot already, right? So we've covered a lot of things. Anything you want me to drill in on a little bit more, or focus on, or back to where we started out? Are there any specific questions that people have about their own sort of background that you want me to talk about or help with? Yes.
I have a question on the model. I saw multiple on invested capital under IRR.
Yeah.
Is that the multiple we use to multiply by the EBITDA, or something?
No. That's the output. So that's basically like, how much money am I getting? If you invested $1 billion, you're getting out $3 billion of equity capital. So you're getting 3 times your money on what you put in. What you're using is more of the multiple of EBITDA. So we're keeping that the same as the entry. So it's 10 times entry, we're keeping it as 10 times exit also. So that's quite a little bit different. Does that make sense? Okay, amazing. Yes.
One more question. So why do PE funds use the excess cash typically to pay down the debt rather than distribute the cash out? Because, well, number one is it doesn't help with your IR. Number two is don't you want to have more interest tax shields if you don't pay down your debt?
Yeah, look, I think there's so what you're saying is a dividend. Basically take the money out for yourself. Yeah, look, can you comment a little bit on covenants around?
I was gonna say two things. I think one, at least what I've seen is in practice, there's usually not as much, there's so many other things you do year one, year two, that there's usually not as much free cash flow available as what you kind of model out here. So in practicality, you might have like $2 or $3 million of increase in cash at the end of the year. The second that is usually in loan documentation. We have minimum, like as a lender, usually it's just 1% repayment a year, but like I want to see some of that cash being used to pay down debt. So I'll have minimum requirements, whether it's, 50% if leverage is a certain toggle, down to 25%, down to 0%. So we want to see some material deleveraging before you then go to pay down a dividend. But at the end of the day, like if business is performing and like a lot of times we'll pitch it to recap and say, why don't you recapitalize the business, relever it and pay a dividend to shareholders.
Right. Which technically you can take all the refi proceeds during the interim and then increase your IRR anyway.
100%.
Yeah. So look, the ideal thing would be that we get all our money out in like year one or year two, right? So there's sort of, if that's the case, then we're not, it practically won't work. Maybe because you're kind of, then maybe you're not putting in the right amount of sort of entry multiples. If you're in a position where you're buying a company that's spending out $100 million of cash to get cash out year one or year two, then somebody else there's some mismatch between like how much you're paying to sort of what you can get out. The other practical reality is, we could use capital to reinvest in the company, right? Rather than have to put more capital in. There's covenants that say you can't take out a dividend until certain thresholds are met in terms of debt, total debt, EBITDA, all of these things because what the bank wants to avoid is we basically take all the money from them and then we take it out of the company in a year or two. And that's sort of not the goal of why the bank is lending to us versus the company. But yes, you can do dividend recaps if there's a ton of cash, if there's sort of a blockbuster deal that happens or something like a drug that happens and you get a ton of excess cash, you can dividend out as long as you're meeting these requirements that the banks have and you don't have sort of other investments that you can do in that company itself. So yes, I think, the holy grail is to get your money out ASAP, but it's not as easy as sort of possible. Because I think you're right. If you can get it out in 3 years, you shrink your IRR. I mean, literally, if you go 2x IRR from 3 to 5 years, you get 25% more IRR. But then you get a question of like, what are you going to invest that money in? Because a lot of times we go in saying, hey, we're going to put our capital. We have in today's market, there's a ton of excess capital at work, right? So we want to find good deals. So if I'm sitting here saying, hey, I could invest a little bit more or use that excess cash to grow at 25% for 3 more years, then I'm probably better off leaving my money in there and then sort of, using my excess capital elsewhere. So it's a good question. It's just depending on the deal and sort of all the other dynamics. Cool. Great question. Yeah.
So I've typically heard, at least in the Indian market, that it's sometimes like exiting a deal is a little more difficult than entering a deal. Is that true of the US market as well?
So how do you exit? It's a great question. We haven't touched this yet. So what are the different ways we exit a deal? Yes, in the back.
IPO.
IPO. And why would you do an IPO?
Equity markets are flooded.
In what situation would you do an IPO?
The company's now later stage. You can get multiple expansion.
Yeah, and there's a lot of like public market. So it's supportive of the public market. There's a lot of things team when an IPO, which you guys know, like you gotta have a management ready team. Like you gotta have a management team that can handle sort of an IPO context. You gotta to get a company from private to public, you have to set up all of these infrastructure in place. Like you do regular reporting, regular sort of documentation, filings and, analyst research, whatever. You may have to install its own IR function, all of these things that are a little more nuanced, right? So typically the PE option is to sell it to another PE firm, right? Because there's a lot of things you need to do to get that company IPO ready. However, the IPO market gives you an immense amount of sort of liquidity and sort of certainty of liquidity and so on. But in an IPO, like we can't get our money out day one. There's sort of lockups, right? So the public market isn't going to allow us to just dump all our stake in day one and then run away, right? So they want to say, hey, our sponsors need to at least be in the company for 6 months, whatever, 9 months or whatever the lockup period is. So you may only be able to offload 20, if you're 100% owner in a company, 20 to 30% in an IPO. So you kind of have to sell down over time. It increases a lot of risk, right? What if the market isn't so great in 3 months? And there's sort of another risk. Again, I'm getting into more like M&A finance here, but there's other risks of like when you sell huge chunks of your stake, there's a liquidity discount, right? You may not be able to offload, if it's a $2 billion company, like $700 million of a stake into the markets and expect the retail markets to just eat it up. So you have to kind of slowly do these block trades and so on over time that reduces stakes. So the IPO is higher reward in that you can get all these retail investors. You have sort of more price discovery. You can have more people in the deal. And presumably once a company's public, you can kind of see a track record for public liquidation. Whereas private markets, you're a little bit subject to the other PE investors buying your story, right? The lending markets have to be good. All these other things have to be good. So it's a real question that we ask every single of our portfolio companies, right? So like, should we IPO it? If so, how do we need to get it ready? 2 years before it can even IPO, we need to put all these things in place. We're going through a public market route. Timing is more important, right? So how stable are the financing markets? How stable is the valuation market? How many real buyers do we have for a $2 billion company? Do we need to form consortiums? Like there's a lot of other things in stake. So IPO, and so a lot of times private equity firms do what's called dual track, right? So they'll hire an investment bank and they'll say, go on IPO route or go path of sale. It sucks to be an investment banker in that case because you're doing literally two things that there's 50% probability on individual of those things, but we want to also maximize our optionality and so on, right? So it's very nuanced. Like, I mean, we could have a class just on exit options on a PE deal, and it'd be super interesting, right? I think and maybe we'll do that in one of our overall Zoom panels. As I think I've done plenty of these deals. I think we speak to that. We get other people to speak to that. It's a really good question. Great question. There was one in the back.
Yeah. I just wanted to understand a little bit more about the role of, say, a post-MBA PE person, because say we covered the financial modeling perspective in detail.
Yeah.
Would that be something that is run by the pre-MBA person, or are there funds where even the post-MBA VP senior associates are sometimes running the intricate financial models?
Great question. One is depending on the firm itself, right? If it's sort of yes and no. So yes, the pre-MBAs are running the models itself. Where you guys come in, actually, this is the only piece we skip. So I might actually spend a minute on this because it goes through a lot of the questions that you're asking. But without going into this, I'll just summarize a little bit. Your first 6 to 12 months, you're going to be given models. You have to build models from scratch. Even if they'll look down you on deals where you are sort of the only senior associate or junior VP. This is because we just want to make sure that you can do it our way, right? Or you can kind of do it in the way that we're looking for. And it's not great for us to have you go into, not you, but anyone, right? Go into the firm and not at least go through 2 or 3 of these situations where you've sort of run end to end the financial stuff. So if you have an analyst, we still kind of would put you on kind of a sole sort of lead model phase. However, you're right. In your purview also comes in, you get a sim. You are the one who is going to tell us a recommendation, right? So you do a round 1 model or something and you tell us, hey, this is why I like the industry. I like all this stuff. So you're pretty much in charge. We let you guys be in charge of end to end evaluating a thesis just for the initial screen and telling us if it's worth spending time on. So that's another thing, right? So you maybe spend a week, let's say you get a sim, so even before that, you're negotiating NDAs, right? So the pre-MBA may not be doing all that stuff. You're sort of interfacing with the bankers to understand what's the dynamics around the deal. The pre-MBAs are not going to do that. You're going to build that initial model. You're going to talk to bankers on potential financing or potential whatever. Usually the pre-MBAs aren't going to do that. And then you are going to obviously negotiate the NDA with the other party and then get the actual documentation, put together the initial kind of thesis that you're presenting on. So all of those things you're going to be working on probably for the first 6 months. I think eventually you might offload some of that to the next person. Then when it comes to a deal, which is, I guess this is round 1, we'll get to this time permitting, but when it actually comes to a deal, let me walk through this. On a deal side, again, all these slides are available to you guys, so obviously you can go back. In an actual deal, right? So you are doing kind of with the associate or not, you're doing the round 1 model, you're submitting the kind of, but then you also have to convince your partners that this deal makes sense. So you're walking them through that as well. I mean, look, at that point, you could be delegating more and stuff. It's fine, but the first 6 months, like I said, different from the next 8 to 12 months. Then you're kind of in charge of submitting the bid. And sometimes we may not do this yet, but you may be interfacing with the banker, say, hey, this is where our bid comes in, and how does it look like with the other bids, and so on and so forth. Then when you're invited to round 2 is when it really kicks up. So you're going to be largely in charge. Depends on the firm, right? If there's a VP that's similar to you in level, maybe they're going to be running the diligence, so you'll support them. Or if the principal is much more senior, you'll be running all the diligence. Again, just depends on the deal. And there you'll be in charge of all the diligence, right? So you're going to be working with the lawyers, the bankers, all that. And at that point, you can start sort of, once you get to round 2 is where I see a lot of delegation going on because you bring on an analyst or an associate and they run the model because now you're going to be doing 10 different work streams and making sure they're all sort of on track. So there you're kind of going through doing market stuff. You're working with, the consultants, the lawyers, whoever. And at that point in round 2, maybe your responsibilities like elevate to more to a VP type role. And then you have this person to support you. Again, we're so short staffed like all the time, right? That we're going to try to get you guys involved, deep at the beginning and then eventually evolve over time to take on more higher level roles. But then again, if you go to a middle market fund and there's 4 partners and like you're the only VP and there's like 1 associate, maybe you're doing a lot of outreach or a lot of modeling or whatever. So it just sort of depends on the firm. Is that helpful?
That's super.
Amazing. Okay, great. Any other questions? While we're on this, I think look, the key things I want you to take away from this. Outside bankers give you information called a teaser, which just has like high level stuff, not gonna have a lot of info. I think 95% of my MBAs, the first thing they do is negotiate NDAs. So you are working with the other counterparty to figure out what are the terms of confidentiality. Why is an NDA important for both sides, especially the sell side, sellers?
I mean, you don't want information to go to like
Yeah.
competitors, et cetera. There's commercial, there's this commercial angle to it. So like there could be sensitivity there.
So that's exactly right. That's exactly right. Look, if there's 10 bidders in a process, by definition, 9 of them are going to lose, right? So you, as a seller, are going to be very, very cognizant about who gets your info and how they get it and how they use it. The biggest ways, right? If you're a strategic in the process, they could come and you just shared with them literally everything about your sales org and who the best salespeople are. They can literally come and take your best salespeople and go and run their own company, right? They don't have to pay the premium of your company, right? So there's a lot of strategic reasons why NDAs are important. But you as a sponsor, you want information. How can you make a decision if you don't have information about the salespeople, right? How do you make a decision based if you don't have sort of all these other things? So it's really a nuanced process where you are, as the post MBA are going to be negotiating with the other side. Hey, this is what we need. We can't go under a 12-month confidentiality because if I can't do any deals in the healthcare space in the next 12 months, then I don't have a job, right? So let's get down to something reasonable. Let's carve out certain things, right? I can't forbid my portfolio company that does something similar to ever hire anyone from your company. There's no way I can control the director of finance not to hire someone. So let us just cap it at director level and up, and anyone I meet in the process, and anyone below that, so be it, right? So we have to sort of negotiate a lot of the non-solicits, non-competes, the confidentiality period, all that stuff. So that's why that becomes really, really important. So once we have that, we get more information. You get access to the SIM and so on. You build your models. You submit round 1 bid. So the other thing I would say, it's all from years of experience that I want to share with you guys. A round 1 bid is really important, right? In practice, a round 1 bid is sort of taken as just an indication of interest because that's what it is. But it has to be viable, right? You can't go into a process and lowball something, or you can't go and super highball something because your credibility is on the line, right? And it's also your time's on the line. So why would you not want to lowball like a deal? Yeah.
I mean, you won't be let into the process.
Right. It's not a credible bid, right? So what are you doing, right? So like you do two or three of those and you're not going to get any more sense, right? So it's sort of like you just have to sort of be in the market and do real work. And any other reasons? I think there are some new hands here. Okay, why don't you want to highball a bid or try to be super favorable in your bid? I'll go to you in a second. Is there any new hands? How about you in the sweatshirt? Yeah. Yes. Yes.
I mean, you're kind of anchoring at a price point that you might not be able to meet when you actually submit the file.
Point, right? So you don't have this is the right. This is a put and take is that you don't have enough information to have a very credible bid or a super detailed bid. However, you still need to do the work in round 1 to get to a point. That's why I say use any lever that you can, right? Go talk to bankers, go talk to financing providers and get to a number that is reasonable. The other reason why you don't want to highball something, look, you're going to get in the next round, but maybe you don't want to spend 6 weeks diligence in this company, and maybe you haven't done enough work to get the whole team behind it, right? So, and you just wait 6 weeks, and it's hard to get out of a process once they've let you in, because guess what? What he's gonna hate more than a lowball bid is he's gonna hate when a buyer drops out in round 2, because now he has 1 or 2 less buyers that his client has, right? So it's a really, really important dynamic that I need, everyone here to be like a elite level practitioner and make sure you understand the people and the process side of the world, not just being your model all day, but step out and sort of understand impact it has on your reputation, the reputation of your firm, your credibility in the market, as well as impact on your time, right? So super important as you guys go through these processes to keep that in mind. Again, final round, I'm not going to go into a lot of it. There's a lot going on. So and I didn't get your name. What was it? Yes.
Shruti.
Shruti. So Shruti was asking, like, as you go through round two, your work now multiplies tenfold, right? So you're going and building a detailed model. You're going ongoing diligence, right? You're going in, understanding target strategy, operations, legal, all that stuff. And now you can delegate more. You can hire consultants, you can hire lawyers, you can hire accountant firms, you can hire whoever, regulatory firms to help you go through this. You're doing a lot of ongoing market study, right? So you're hiring Bain, BCG, Deloitte, whoever. And then you're doing what's called management meetings. So, you're going in a room with management for 2 days and really going line by line. I want to understand how this is happening, how the growth's happening, how this is, all of the factors are moving. And then you internally review it, and then you negotiate a purchase agreement. You have discussions with target, right? This would fall under your purview after a year, is figure out like packages for management, right? So how does the incentive structure going to work? How do we incent you guys to stay on our team once post-acquisition? And then I'm equally evaluating, if these 4 people are the CEO, CFO, CRO, and CSO, Katie's great. I didn't get your name.
Charlotte.
Charlotte is great. Cam, not a great fit for us. And Marshall, I think we have to see. So just kidding. But my point is, right? So we have to sort of evaluate you guys and our management team through diligence. When you buy a company, it's too late to sort of be like, oh, do we think Cam's going to be good in this role, right? So you're doing all of these things beforehand before you can do a deal. Then you submit the final round bid, completion of due diligence. Obviously, you get into exclusivity now. So if you are the top bid, you go in, they give you exclusivity, maybe a couple weeks. Get all your stuff done, guys. Like, this is it. So either you're going to buy a deal or you're not going to do a deal. And then you go and get confirmatory stuff. And then all of the other stuff's going on. Here's when the legal work streams kick off. They do the purchase agreement. And finally, you get to signing and then close. I went through this pretty quickly, but I think you get the idea. So again, we could have a whole other class on private equity deal mechanics. But it's an important piece, I think, for you to just get 80-20 right now and just understand how you will fit into all this. And then obviously, if you have specific questions, you can reach out. So, okay. We'll save 5 to 7 minutes now for any free-for-all questions. We've gotten to know a lot of you here. If there's anything that's still burning, I will honor the break, and I will stay in this room until at least 2. I think my train is not till 4 or something to New York, so I can stay. I'm going to stay till 4, but I think I can stay for a little bit. I know a lot of you guys still had questions left, so just come grab me. But let's do any group questions. Yes.
So you mentioned that energy transition was one of the 3 industries with the most fundraising right now. I was wondering, what are the other 2 industries? And second question, is there a market for special situations role at the post-MBA level?
Yeah, look, I'll leave it. So the question was, no, I think I just want to make sure this is pinned. So the questions on what are the most common popular industries right now, look, I think depends on sort of who you ask. It's sort of, I mean, high level, right? Just kind of go in and see who's raising the most capital and where the kind of most deals getting done, right? So fintech is always going to be really strong. I mean, I don't want to do a general answer because your experience is going to be very different. So I don't know if you're going to be a good fintech sort of investor or not, if you have enough background in that space. So I would go about it a different way. I'd pick sort of the industries that you do have some experience in and kind of see where is the opportunity for those segments to sort of, does that make sense? There's a little bit of a nuanced way to think about it. Look, even if it's healthcare, right? Maybe, obviously the last 2 years, pharma has been doing amazing well, biotech's been really well. Maybe, hospitals, the next couple of years may not be doing, maybe not, there's not as much growth in that space. I'm just making something up in an industry I'm not too familiar with. So the ways to do that, though, let me give you a framework to answer that question. See who's raising capital. Kind of, what are the big players raising capital in that space, especially at middle market level, right? Because at the mega fund level, you're going to have generalized funds. They're going to say, hey, we're going to raise, a $9 billion fund that does all private equity in North America. But see sort of who's raising capital at the industry level. Then see sort of what are the deals, sponsor deals that are getting done. So if you pick healthcare, then I would pick sort of what are the industries of deals that are getting done. Is it pharma? Is it bio? Whatever. You can get all this stuff from a lot of the Bloomberg or Cap IQ or whatever data. that's how I build that piece. And the second question around restructuring, but restructuring is a little more tricky. You're restructuring, you guys are, some of you are restructuring. It's not tricky in the sense that, I mean, maybe you think about private credit, right? Or maybe you think about sort of value-based investing, right? So where people come in, at sort of lower than growth valuation, you're doing a lot of work on balance sheet and so on. So, Centerbridge or Apollo and these types of firms do work on that. Again, I'm giving you high level names. Versus like, a Warburg that does a lot of growth investing where it might be a little bit more of a, harder of a delta, right? For your story. Again, that's my initial thoughts on restructuring. You can look at credit as well, right? So private credit has raised more money in the last 3 years than sort of anywhere else in the market. So clearly a lot to do, especially if we go down into sort of continued stress in the public markets and sort of valuations and leverage. I think that could be a great place to start in terms of just getting a lot of deal activity in the next 2 years. Again, goes back to a little bit of what you wanted to do.
Thanks.
Yeah, no worries. Let me take one or two more. There was a couple more hands that I didn't get to. Anything that you guys have want to raise? Yes.
I just have a question on how to frame consulting projects when it comes to interviews, because the previous slide was more around deals or transactions.
Sure.
So I was just wondering how to shift that to consulting.
Can you give me an example of a project?
Like I worked in McKinsey, part of the FIG practice across the Middle East, and one of the projects I did was a growth strategy for a Fortune 500 bank.
Okay. So was it like a particular segment of the growth? Because obviously, were you doing overall growth of the bank?
Growth in MENA across the
MENA. Okay, so yeah, I mean, I think, and so that we may need to. That is not like because it's not like an end to end. You're sort of kind of. I think what you would have done is, hey, let's look at these 3 or 4 market segments, and this is the areas we want to go in, and like this is the revenue potential of this space. This is whatever here. This is what the investment requires in this space, and this is sort of what the ROI or impact. Right? That's probably the analysis, right? Okay, great. So I think in that case, it may not be a great example for this situation, right? You could either take the bank as a whole. That's why I was asking, is it part of the bank or the whole bank? So if it was sort of overall top line revenue growth for the bank, then it might make sense to do that and kind of contextualize it. Hey, this is a transaction that I did. Did you work on any other sort of things that were, and if not, it's okay. You can sort of say, hey, I did growth strategy for this. I'd like to take this and evolve into this other thing, but I'm still going to go into that bank. And a bank is already tricky to sort of put in a private equity context, because there's like the balance sheet's different and so on. So maybe I think a little bit about some of the other projects. I mean, what's your other projects that you can cite here, or was this the main one?
I mean, that's an example, but it was mainly bank strategies for bank.
Yeah. So FIG deals. Did you do any like insurtech, fintech payments, anything like that?
Yes.
Okay, great. I think those are more PE-able sort of businesses, right? So a bank is, yes, you can put like a bank balance sheet, right? Bank makes money. Bank doesn't have EBITDA, right? It makes money on that interest income and other things. So you can do that. There's like companies like JC Flowers and other firms that do specific, or Apollo or Centerbridge that do that stuff. But if you have if you're ambivalent, I'd probably take an insurance broker, insurance tech, payments, something like that has a more like straightforward cash flow, and then talk about, hey, this is a company that we help do X, Y, and Z. This is how we can fund in that context. But your broader question about deal or not, like that just depends on the deal. Like if you did end to end, or if you did some part of the diligence, or you did some part of the operations, you can speak about that. If it was all just pure strategy, then you're going to have to be a little more hypothetical. Then I don't. We'd have to bridge a gap for you between just growth to now a deal transaction, in the thing. And maybe you need to get a summer of M&A to be able to fully bridge that. I don't know yet because I don't have your full background. But if it's just on surface, I'd say pick deals that have sort of more PE-like, and then a deal where you actually did a little bit more than just the upfront growth stuff, where you actually was a transaction involved. Then I start with that. Is that cool? Okay. What was your name?
Yobna.
Yobna. Thank you, Yobna. I think there was one here. Yes.
Amy.
Amy. Hi, Amy.
Hi. I have a question on networking. So you stress the importance of networking and then the approach. Can you offer some general advice on while you're conducting the networking, what are some good etiquette, best practice of following up?
For sure. One thing I'll say, my team wanted me to tell you guys this. So we have this thing on Trustpilot. We'll send this link out, but if you guys can go in, if you had a good experience, just go in and put a good review on or whatever based on what you learned. It's more about for them to grow, right? To do these things more. So I'll send out the link out. It takes like 2 seconds. You can go and talk about it. But and it's just Elevate. I think it's still our old thing, Elevate Lab or something. So we'll send that link out. Just make sure you do it 627. On the networking piece, are you having trouble with something, or are you just kind of asking a general question?
I think it's so like starting is the first step, and then to maintain that relationship.
Yeah. So a lot of the thematics that I talk about, look, everyone in this room, whether you're telling me this now or not, is going to have trouble in networking, right? It's just one of those things that it's not like you just. I mean, other than Bill, who had a great experience networking, it's sort of. I want to be a little realistic here, right? It's not easy, right? Because if it's too easy, then I think you need to up your game a little bit. You know what I mean? If you're sort of not getting any rejections, then I think you're in a different league than where you need to be, right? So that's sort of my point, maybe more largely, but I want you all to get rejected. It means that you're kind of challenging yourself and sort of, putting yourself out there, to do that. But now how do you get rejected less? So I think you make that, you have to really introspect and understand why you and why them, right? It feels like I'm giving dating advice right now, but it's like really like, why should they respond to your email? Like, why should I take the time out? And not that I'm like this some great person or whatever, but all of our people are busy, right? So what about you and your background is a value add for me? And it can come from a perspective of, hey, I just want to learn. I'm an alum, you're an alum. I want to learn about this, but let's get into a little bit higher than that. Hey, this is where I'm coming from. I'm really interested in the sector that you guys are working on. I'd love to learn more. I'm going through the PE sort of exploration process now. So which could be set up 10 minutes to just kind of go through it. So hopefully you figure out what that message is that works for you. And it has to be a combination of who am I? Why? What value can I add? Who are you? Why is it relevant that I'm reaching out to you? And then sort of what is the next steps? Okay. Then there's follow-ups and all that stuff. The second piece about staying in touch, look, those are the strategies I talked about earlier, right? Take detailed notes about what you talked about, have an engaging discussion, send follow-ups. If you're in New York, go visit them, right? It's not that far. I would actually even recommend people that are super serious about banking or PE, take a trip every 2 weeks and like say, I talked to you on the phone. I'm going to be in Chelsea, or I'm going to be in Midtown. I'd love to have coffee. Just let me know what works for you, right? I mean, these are just ways you can, if you have 20 coffee chats or Zoom chats, only 5 of them will actually say yes, but at least 5 of them said yes. And that, now I put a face to a name, Amy, we have this conversation. Again, it's not mandatory, right? I get it. Or you, like I said, you keep notes on what these people are working on and then send them stuff, right? Especially in the VC side and growth side. If you, VCs are like perennially underwater, right? They're looking at new sectors every single day. They have no idea how to organize like in a broad sense of things. So if you can help them and say, hey, here's a quick thesis I put together on this industry, or here's the 5 deals I think are interesting, or here's my market map of the industry. That way you have something to talk about. And that way you don't need to do this, but you can sort of get these conversations to a next level and keep leveling up these conversations, because a lot of these conversations get stuck in, hey, I'm Amy, I'm an HBS student. I'd love to hear about what you guys are doing, X, Y, Z fun. Cool, I get on the phone and tell you, oh, literally they walk you through what I walked through on a slide. And then you're like, cool, I'd like to keep in touch. And then 2 weeks later, you email them and they're like, who is Amy, right? I don't even know what we talked about, right? So I think you get into that conversation and be like, hey, I'm interested in energy. That's exactly what you guys are doing. This is what I've done. And this is why I think it's relevant. So I would love to stay in touch about deals I'm seeing in the space, or when I'm in New York, we do this. So at least now you've made a leap from just a green student to now an actual someone that they can actually consider as a real candidate. Again, it's not going to happen for everyone at all same directions, but I want you all to get from a student to I'm a legitimate candidate, and this is why I'm a legitimate candidate. Or it could just be general advice. That's fine too, but you have to get to that at some point with someone, right, for this to happen. Cool.
And then just a quick follow-up.
Sure.
What's the seniority range that you recommend?
Seniority. Of the level of thing. Really no limit. Whatever. I think certain times senior associate VPs are the closest to sort of the day-to-day and the people side of things. Usually the partners are super removed from people side of the world. Again, if you but they're also really hard to get on the phone or get on the Zoom because they're super busy, right? So I would say don't limit yourself based on level. I'd say maybe start out, because the risk reward is higher for the senior people. Maybe start out with more of the associates, senior associates, VPs. Once you get to know the firm a little bit more, get to know what you're doing, look, your first 3 or 4 networking calls are going to be complete disasters, right? So like, I mean, hopefully not, but I'm saying relative to where you'll be, right, in a year. So don't be afraid. So just reach out to an HBS person who graduated last year and say, hey, I'm going through this. Like, this is what my story is. This is what I'm doing. Sort of any thoughts on this? Any thoughts on your firm? They'll say, hey, I think you need to tighten this up, whatever. Focus on this. But, we might be hiring next fall. So let me put your name in our thing. And you'd be like, hey, okay, cool. I'd love to meet more people on the team, blah, blah, blah. And you keep it from there, right? So, or they say, hey, look, Amy, honestly, like that wasn't great because you didn't get to these points. So let's work on that, and you know what to work on, right? So it's sort of that's my view here. You never want to sort of use that capital up to an MD like day one, because if you don't do as well, it's kind of lost, right? MDs have more say in the process. It's hard to get a hold of them. So I don't want to handicap to you, and I'd say like if you can get to 60 to 70% VPs or senior associate and 30% MDs and partners or directors, I think that's a healthy thing. But it's more about what's the point, right? Like if you're reaching out to a healthcare company and the next year you're reaching out to a consumer company and the next year you're reaching out to this, you might be talking to 3 different associates, but are you proving yourself to be a legitimate candidate for those? Like that's the bigger question. So I need you guys to sort of keep going to sort of prove that you can do that, right? So starting conversations are fine, keep in touch with them, but if you're having any tractions, you'll soon realize that they'll start introducing you to other people at the firm. You'll start meeting more people at the firm. That's when you know you have real traction at that point, right? Does that make sense? Okay. So, we are sort of ahead of even where the break was going to be. I'm really cognizant of everyone to sort of sit in the seat for 2 hours or 2.5 hours. So, are there any other burning questions that you want me to answer? Burning for you or burning for the team? I didn't get you earlier. Was that a burning question?
I had the same exact question.
Amazing. Anything else, guys? Like I said, I think we've covered a lot today. I'm a little out of breath, but I think we've covered a lot. Yeah. Okay. So there's a couple more.
I'm just curious if it was easy for you to break into private equity, having done investment banking after your MBA.
Good question. It was not easy, but it wasn't impossible. So, look, I think at the post MBA level, it's if you get calls from recruiters, they're trying to call you to place you in other banks. So you're gonna have to do a little more of your work to get them to understand that this is why I'm gonna be a good candidate. So the banking or consulting post MBA could check these other boxes that you don't have yet, like M&A or deal work, but not going to fundamentally change like your ability to be an investor. So you have to, again, continue that networking angle. I always tell you guys, first 12 to 16 to 18 months is the best time to transition from banking or consulting into PE, again, post MBA. And they're going to happen in the industries you're covering or the funds that you're working with or on the other side of. So technically your networking you do now could pay off in 3 years out. It's not easy. I'm not going to say it was not at all easy, but I was committed to it, and I took sort of 6 months to talk to a bunch of investors. I did thankfully get on deals, so that's the other thing. Try to go to places where you get real deal experience, right? So that's the vetting process you need to take on if you're going into banking, because a lot of times it's sort of like, what have you done lately, right? So what have you done the most recent? And so get real deal experience and then sort of commit to it for 6 months and see how it goes. I think you're all fully capable of doing that. It's just hard to commit in banking when you're working like really late hours and you're like, when am I going to recruit, right? Like it's just hard, right? So this is true for other things. I mean, we have families and there's other personal things that get in the way. So I'd say, give yourself some time to do it. But if there's any inkling that you can do it now, try to do it now also, right? So that's my thing. We can I can give you more sort of color on the process. There was maybe one more. Yeah, Andrea.
Yes, what about the timeline of the recruiting process? So, I mean, we should start doing networking now, but at what moment, like?
Yeah, so you'll see a lot of funds come in for information sessions and so on, or virtual sessions like we'll do for virtual sessions on Zoom for funds and stuff. It'll probably happen. Again, this year with the markets and sort of dry powder and whatever, it's a little bit in the air. But last couple of years, it sort of happened in the fall where some of that recruiting has happened. Headhunters could reach out like any moment. So you just sort of have to be ready. Again, if you're targeting the large cap funds, right? And if you're sort of in the middle market or mid market space, you can operate on your own schedule a little bit. So timeline for most of these like middle market funds, if they're not headhunter driven, it could drag out till like the spring, right? So they don't know their headcount and so on. But for a lot of their large cap funds, it'll happen. They like to be structured. So they'll come in like October, November, December, because we're in October already, but November, December, or January to recruit for you guys. I mean, a lot of these, have people been getting reached out by headhunters already? There's not as much here. Okay, cool. But I think my point is this year is a little tricky with the economy. Like, we just kind of don't know, but I would expect some of those things to come down the pipe in the next, they're going to happen at HBS. You don't have to worry that like, you're not going to see it. Whereas like maybe some of my other schools may not see all the roles, but I want you guys to spend the next few weeks just getting into that mindset. The other thing you guys need to take is banking and consulting recruiting is going to start up too. So if any of you guys are thinking about A versus B, you have to kind of make a call on banking in the next 2 to 3 weeks also. Again, this is for the segment of people who are not sure. And banking is also like they fill about 80% of their class by January. So how much like opportunity cost of time do you have versus how much risk are you willing to take by skipping that process and then waiting out till later on in the spring? And most middle market firms, you probably will get sort of in that process in the spring. So the timing is a little not great for people who want to, sort of have their cake and eat it too or whatever. But you have to sort of make a call on that. Consulting probably happens closer to November, December, Jan, Feb. Banking goes first. But does that kind of make sense on timeline? You may get pushed out if it's a middle market fund, even to like.
Also, a little question about that. Imagine that. I'm going to the megaphone. Like, okay, I go to this like formation session, and how is the application? In consulting, it's like 2 rounds, 2 interviews, like 2 weeks apart.
Yeah. So it depends on the fund. I'd say if you're going to a full-time role, you may go through 6 rounds of interviews, right? Or something like 6 different people you're speaking to. It'll be behavioral first, and they'll give you a case, and then they'll